Hello, you're watching Dukascopy TV, and we follow on from yesterday's very brief look at the cable where pressure is mounting on the Bank of England to hike rates and hike them soon. Joining me on the line from London is Jeremy Stretch from CIBC. Now Jeremy, we know the BoE is under pressure right now. I've been told by some market players we won't see a hike until early next year, but it's got to come sooner, hasn't it?
Well, I think we're in a scenario where central banks are very mindful of tightening and tightening too soon, and so I think the greater risk for most central banks would be the risk that they take preemptive action, and I think they prefer to be criticised for being a little late in terms of turning the monetary policy cycle. But I think from a UK perspective, I think there is an important additional dynamic, and that comes in relation to the influence of the housing market in terms of the recovery process. And I think in that regard, we may well find that there's going to be some imposition of macroprudential measures to try and slow the housing market. And I think that will preclude the need or will mitigate the near-term risks of monetary policy tightening in the UK, such that I think we are still going to be on hold until spring 2015, because the slowing of the housing market, I think, will probably alleviate some of the risk parameters normally associated with monetary policy tightening.
The Confederation of British Industries said they've upgraded UK economic growth this year to 3%. This is higher than pretty much every G7 country. Why then have we seen a drop in the pound after massive gains? And are you confident it will find further support in the near term?
Well, I think in the context of sterling, we've seen some considerable gains, and we've seen the trade-weighted sterling trading at exaggerated levels over the course of recent weeks. So I think what we've been seeing is that markets have been preempting the strong growth story that we're clearly seeing in the UK, and we've seen that reflected in upgrades in terms of macroeconomic forecasts from not only the CBI but the other international trading organisations such as the IMF and the OECD as well. So strong growth, I think, is very much baked into the scenario as far as UK PLC is concerned. I guess the question from here is, are we going to see further positive surprises which would encourage additional sterling support? I think we're already seen the investors adding to sterling long positions in pretty significant levels over the course of the last few weeks. So I think we would need to see further impetus, further positive surprises to encourage additional sterling gains. And of course, at the margin, you could argue that the acceleration or appreciation in sterling will act as a natural break in terms of both tightening monetary conditions, but also alleviating some of the benefits to the export sector. So I think it is the case that sterling is close to being fully valued, certainly against the US dollar, albeit it may well still have some potential appreciation against some of the other currencies, particularly the euro.
Nevertheless, the pound is looking buoyant, but 10-year gilt yields, on the other hand, are on the rise, and that isn't good for government bonds. But does that matter during an economic recovery, and will it affect trades at all?
Well, I think we've seen, obviously, gilt yields being held down, partially artificially, because of course we've seen that significant official buying under the QE process, albeit of course that's now come to an end. But I think if we are going to see yields moving up, that's consistent with recovery prospects taking hold. Of course, that does have its own inherent downside, largely because of course the cost of funding our deficits gets that much more exaggerated. So I think it's a case to say, well, rising gilt yields on the basis of stronger growth is a virtuous scenario, but of course in an economy which is still suffering from a very sizable structural deficits, that doesn't come without cost in terms of additional financing. So it's a little bit of a double-edged sword as interest rate markets continue to reflect the stronger growth prospects ahead.
Finally, what's the next step for the UK economy and for George Osborne right now?
From a political perspective, clearly, as we're less than 12 months away from the election now, I think there's a very positive backdrop for the politicians, or at least the governing politicians, because, of course, the economic environment does look increasingly virtuous. I think from a political perspective, the Chancellor would probably be well served just to leave his hand off the tiller and just encourage the growth prospects to continue to improve over time. But I think it's very much the case that we're most likely going to see that rate hike coming before the election, which I think could be seen as both an advantage to savers, which would potentially play out well politically. But I think the other issue that's going to be relevant going forward is going to be not just the MPC, not just the Chancellor, but also looking at the FPC in terms of the macro-prudential environment. And I think that's going to be as important for the broader political and/or macroeconomic prospects for the UK as we look at measures in terms of that macro-prudential sphere to try and slow the housing market without the requirement of that rather more blunter-edged sword of more traditional monetary policy.
OK, thanks for joining me today. Don't forget to check out tomorrow's interview on UK labour market data and the latest inflation report. Monica Gibson will be hosting that. But for now, from me, bye-bye.